Today on Retiring Well with Centennial Wealth Advisory, we are exploring the differences between mutual funds and exchange-traded funds.
What we're seeing today is we're seeing a tremendous growth in exchange-traded funds.
We'll share the three big reasons of why investors and financial advisors are moving away from mutual funds and toward exchange-traded funds.
And we're exploring the reasons behind the huge growth of exchange-traded funds at the expense of mutual funds. People are moving away from mutual funds, are going into exchange-traded funds. They're doing it in just droves. Why?
All this and more on Retiring Well with Centennial Wealth Advisory, starting right now.
Retiring Well with Centennial Wealth Advisory, helping you make smart decisions with your money so you can live a better life. Today is the day you can take back control of your money. Retiring Well with Centennial Wealth Advisory, where we believe your best is yet to come.
Welcome to Retiring Well. I'm your host, Michael Reese, and we've got a terrific show lined up for you this week. We are exploring why are investors and all the top financial advisors moving away from mutual funds and moving into exchange-traded funds. We're seeing a real sea change happening right now, and we're asking the question, we're exploring the question, why? Why is that happening? And this is something you're going to want to know about so you make smart choices with your retirement planning. Now, before I do that, what we do every week is I take a moment and share with you why we do this show. You know, I believe your best is yet to come. I believe the second half of your life is going to be fantastic. It's going to be the time of your life where you can pursue activities that are meaningful, that provide fulfillment. You know, the types of activities, maybe it's spending time with your grandchildren, traveling, pursuing hobbies that are fascinating to you, whatever it is. This is a time of life where we get to do all that stuff. We get to pursue our passions. But of course, if you're going to pursue your passions, you got to make sure you're making smart choices with your money, because let's face it, your money will support all those activities. You make smart choices and you don't have to worry about money while you're doing those other things. Now here's the problem though. In our world today, if you look at most of the financial media, the overwhelming majority, they don't focus on how to protect what you've built or how to take some income or even grow it a little bit in those circumstances. What they're doing is they're all focusing on, hey, here's how to grow a portfolio. Well, guess what? You've already done that. You've grown your portfolio. Now you're retired, or maybe you're nearing retirement. You've built up your nest egg and you are financially secure. Your primary job now is, hey, I don't want to go backwards. Your primary job now is protect your principal. Maybe take some income. And at the same time, you still want to grow it a little bit. That job is very different from just trying to grow a portfolio. And that's where we come into play. We help you identify and make smart choices when it comes to the areas of protecting principal, taking income, and, if possible, growing a little bit. All right, so let's go ahead with that being said and jump into this week's topic. We are talking about mutual funds and exchange-traded funds. And what we're seeing today is we're seeing a tremendous growth trajectory in exchange-traded funds. Mutual funds, not so much. I mean, look at Vanguard. How many new mutual funds has Vanguard made in the past few years? None. What are they creating though? They're creating a bunch of exchange-traded funds. Even Vanguard's seen this happen. So what is an exchange-traded fund? I mean, we all know what a mutual fund is. A mutual fund is, you put together, it's a collection or a basket of stocks or bonds, and you put your money in there, and it's managed professionally, and you get diversification all in one place. So what is an exchange-traded fund? Well, an exchange-traded fund is very similar. Same thing, you put your money, it's professionally managed, and you get a basket of stocks or bonds depending on what you're investing in. But here's where the difference is. Think about Vanguard. At Vanguard, you have what are called actively managed funds, but you also have some index funds, like the S&P 500 index. An exchange-traded fund is a clean as a whistle index fund. That's what it is. If you get an S&P 500 exchange-traded fund, that fund's going to hold all 500 companies in the S&P 500, and it's going to hold each one in the percentage that it's supposed to be held. You get if you get a Russell 2000 exchange-traded fund, it's going to hold all 2,000 companies of the Russell 2000 in exactly the percentages that they're supposed to be held. They are a clean as a whistle index fund. They hold exactly what they're supposed to hold, exactly in the percentages that they're supposed to hold them, and they buy and hold. They don't change anything unless the index changes. So why are investors flocking to those versus mutual funds? Well, I don't want you going anywhere, because coming up after the break, I'm going to give you the top 3 reasons that investors are doing exactly that.
Have you called us yet to meet with our team? Let us help you with your retirement planning. Today is a great day to take the first step. Call us now at 512-265-5000.
Essential financial strategies for a comfortable retirement. Join the Centennial Wealth Advisory team for an informative and exciting presentation with complimentary gourmet dinner, and learn how to protect your assets from market volatility, how to plan your retirement, the best ways to generate lifetime income, how to safeguard your assets from unnecessary taxation, the difference between retirement advisors and Wall Street advisors, why getting a second opinion may be your most important financial decision, and much more. Choose the date and location that works best for you. Wednesday, September 7th or Thursday, September 8th at Steiner Ranch Steakhouse in Austin. Presentations start at 6:30 p.m. and are free to attend with a complimentary gourmet dinner to follow. But seating is limited and fills quickly. Call 512-265-5000 or visit send-wealth.com/events to reserve your seats today. There is no cost and no obligation. Don't miss this important presentation, Essential Financial Strategies for a Comfortable Retirement. Call 512-265-5000 today.
Welcome back. This week we are talking about mutual funds and exchange-traded funds. And we're exploring the reasons behind the huge growth of exchange-traded funds at the expense of mutual funds. People are moving away from mutual funds. They're going into exchange-traded funds. They're doing it in just droves. Why? I'm going to share with you the top 3 reasons that at least top financial advisors are using exchange-traded funds. When you think about it, the top investment advisors, the top financial advisors, we've all been using exchange-traded funds for the past 5 years. We've gotten away from mutual funds altogether. So why? Why have we done it? Well, for the same reasons you'd want to do it. And here are the top 3. Now, there are more than 3 reasons. These are just the 3 biggies. Number 1, with a mutual fund, you never know exactly what you hold. Now, by the way, with an index mutual fund, that's a subset of mutual funds, you do have a pretty good idea what you're holding. But normally with an actively traded fund, you don't know what you hold. You never know what you hold. You might say, hey, I want to invest in a large company mutual fund. Fidelity Magellan would be an example of one. You say, okay, I know I'm going to own large stocks there. Great. Which large company stocks are you holding there? Well, you say, I don't know, but you do get an annual report that tells you. So you get your semi-annual report. You get that twice-a-year report, and it comes to you. Of course, you get it 3 weeks after it's written, and you get a list of all the companies that are held as of the date that the report was written. But here it is 3 weeks later. By the time you got the report, Fidelity Magellan has already sold a bunch of those companies, replaced them with new ones. With a mutual fund, you never know exactly what you own. With an exchange-traded fund, on the other hand, you always know exactly what you hold. Exchange-traded funds are designed to exactly duplicate certain sections of the market. When you invest in that, in a specific exchange-traded fund, you know exactly the stocks you've invested in, the companies you put your money in. So with an exchange-traded fund or an ETF, you know what you own. Mutual fund, you don't. Reason number 2. Top 3 reasons, reason number 2. With a mutual fund, you never know exactly what you pay. With an exchange-traded fund, you always know what you pay, and guess what? 99 times out of 100, it's way cheaper. Now, there's a great article I have in my hands. This is called The Real Cost of Owning a Mutual Fund. It's from Forbes. And what they do is the reason I like this one is it's really clearly written, really well written. I would recommend if you own mutual funds, you need to Google this and just get it. It was written in 2011. The Real Cost of Owning a Mutual Fund. Forbes article, Google it, read it. In this article, it tells you how it's very common where an actively traded fund here in the US, they would tell you, you look up in the prospectus and they say, oh look, it costs 0.9%, less than 1%, 0.9% for management expenses. You think, okay, well that fund cost me 0.9%. Well, by the time you add up all the hidden costs and the hidden fees, that fund often ends up costing you 3%, maybe 4% a year. It's enormous what these expenses can end up being. Exchange-traded funds, they don't have anything hidden. See, with a mutual fund, you don't know what you own, you don't know what you pay. When things are hidden, it gives these companies all kinds of ability to add in expenses. But with an exchange-traded fund where everything's transparent, you can't hide fees when they have to show you everything. Number 3, reason number 3, underperformance. This one comes from CBS News. Mutual funds, are you basically paying for underperformance? Guess what? All these hidden fees with these big mutual funds, you know what happens at the end of the day? It drags performance. And 80–90% of mutual funds do not beat their benchmark. An exchange-traded fund, on the other hand, exactly duplicates the benchmark. So whatever the benchmark earns, your ETF earns. So there you go. 3 top reasons. You don't know what you own, you don't know what you pay, underperformance. This is why people are moving to exchange-traded funds.
Let's talk about retirement income in today's economy.
Are you using your savings for retirement income? Are you worried about outliving your money? If so, you're not alone. In fact, that's retirees' #1 concern, even more so than dying. And unfortunately, in 2008, we know that if another market crash happens, a lot of folks' concerns out there will become a reality. Here at Centennial Wealth, we specialize in retirement income planning. So if you would like us to give you a portfolio analysis to see how your plan stacks up when the next market correction happens, give us a call at 512-265-5000.
Do you have questions about your retirement income planning? We have answers. Give us a call right now at 512-265-5000 to talk to our retirement strategy team. Again, that's 512-265-5000. It's free to talk and we can help. 512-265-5000.
Essential financial strategies for a comfortable retirement. Join the Centennial Wealth Advisory team for an informative and exciting presentation with complimentary gourmet dinner and learn how to protect your assets from market volatility. How to plan your retirement, the best ways to generate lifetime income, how to safeguard your assets from unnecessary taxation, the difference between retirement advisors and Wall Street advisors, why getting a second opinion may be your most important financial decision, and much more. Choose the date and location that works best for you. Wednesday, September 7th or Thursday, September 8th at Steiner Ranch Steakhouse in Austin. Presentations start at 6:30 p.m. and are free to attend with a complimentary gourmet dinner to follow. But seating is limited and fills quickly. Call 512-265-5000 or visit send-wealth.com/events to reserve your seats today. There is no cost and no obligation. Don't miss this important presentation, Essential Financial Strategies for a Comfortable Retirement. Call 512-265-5000 today.
All right, welcome back. This week we are talking about mutual funds and exchange traded funds. Why are mutual funds bad? And yeah, I probably shouldn't say bad, but why are people moving away from mutual funds to exchange traded funds? And what we want to do now in this segment is I want to share with you how mutual funds work and why there are hidden fees in mutual funds, and whereas in an exchange traded fund you don't have those hidden fees. So what's going on there? Well, I want you to think about it this way. Let's imagine here that we have ABC Mutual Fund. So this is a mutual fund, and this fund holds 200 positions. So maybe it's a large company stock fund, and it holds 200 large stocks, large company stocks. And in the prospectus, they tell you that they charge 1% per year to manage the money in that fund. So on the surface, you say, okay, I got it. So they're going to have about 200 positions, so it's going to be diversified, and they're going to charge you about 1% a year. Fair enough. Well, the problem is that's just the beginning of the story and not all of the story. So there's this thing you need to watch out for. It's called TO, which stands for turnover ratio. And let's imagine that in this particular fund, to make the math easy, that the turnover ratio is 50%. Now, to give you a comparison, Fidelity Magellan, one of the really big large company funds out there, their turnover ratio is 72%. So what does that mean? What does a turnover ratio mean, and how does it affect you and the fees that you pay? Well, what turnover ratio does is it basically is telling you over the course of the year how many of those positions are being bought and sold. So if the turnover ratio is 50%, that means that half of these, or 100 of them, by the time we get to the end of the year are gone, and they've gone out, the manager's gone out and bought 100 different companies and replaced them. So let's do a little bit of math here. We have a 50, and by the way, 50%, not an uncommon number. So if it's 50% of 200, that means you have 100 sales and 100 buys, because they're replacing, meaning if you add it up, you have 200 transactions over the course of the year. Now, here's the fun question. Are those 200 transactions free? No, they are not. Even in today's world of technology, it still costs money. But there's more than just the price of the transaction here. It's not just the price of the transaction. Think about it this way. Let's say this is a really big mutual fund, and it has a million shares of each of these sales and each of these buys. So every time they do a sale, they're not selling 1 or 2 shares, they're selling 1 million shares. So over the course of the year, they're selling 100 million shares. And they're buying 100 million shares of these different companies. Now let me ask you a question. If a mutual fund decides, a manager says, okay, time to sell 1 million shares of, oh, I don't know, let's call it Apple or ExxonMobil or Pfizer. When they're going to sell 1 million shares, do you think that has an impact on stock prices when somebody's selling 1 million shares out there? You bet it does. When they're selling 1 million shares, what's happening is it starts depressing the stock price. That means as they're depressing the stock price, they're actually selling on average at lower prices. That's a cost. And when they're buying, does that have an impact? Hey, somebody wants to buy 1 million shares, that's going to increase the stock price. So what's happening is they're buying at higher prices, they're selling at lower prices. At the end of the day, there are additional expenses. And just these buys and sells, they might add another 1% to your overall costs. Now, exchange traded funds, they don't do that. They buy the 200 shares, they hold them. Simple as that. That's why mutual funds cost more, exchange traded funds cost less. All right, folks, I want you to pay attention to me right now. I have a very special offer. If you are one of the first 10 people to call, and our number right here, 512-265-5000. If you're one of the first 10 people to call and you've saved at least $250,000 for your retirement, we will provide for you at no charge, no obligation, your own personalized retirement roadmap. In this roadmap, we help you take a look at where you stand currently with the risks that you're taking with your portfolio, the fees. What are you paying your advisors, both the fees you see and the fees you don't see? What about a retirement income stress test? Will your money last? We also run a tax analysis, a Social Security analysis. This is something you absolutely want. It tells you exactly where you stand with your retirement planning. It's absolutely free, no obligation, but you must be one of the first 10 people to call at 512-265-5000. Call now.
Essential financial strategies for a comfortable retirement. Join the Centennial Wealth Advisory team for an informative and exciting presentation with complimentary gourmet dinner and learn how to protect your assets from market volatility. How to plan your retirement, the best ways to generate lifetime income, how to safeguard your assets from unnecessary taxation, the difference between retirement advisors and Wall Street advisors, why getting a second opinion may be your most important financial decision, and much more. Choose the date and location that works best for you. Wednesday, September 7th or Thursday, September 8th at Steiner Ranch Steakhouse in Austin. Presentations start at 6:30 p.m. and are free to attend with a complimentary gourmet dinner to follow. But seating is limited and fills quickly. Call 512-265-5000 or visit send-wealth.com/events to reserve your seats today. There is no cost and no obligation. Don't miss this important presentation, Essential Financial Strategies for a Comfortable Retirement. Call 512-265-5000 today.
Welcome back. This week, we are asking banks a wonderful question. And the question is simply this: are there any traps that we have to watch out for if we want to move away from mutual funds and move that money into exchange-traded funds? This is a great question because this week that's what we've been talking about. We've been talking about exchange-traded funds and how they are, so much better than mutual funds in today's world. Again, mutual funds used to be the place to be. They made a lot of sense in the past. It's just with technology, and we've seen exchange-traded funds become the forefront, and that's where all the growth is happening. That's where we want to go for a lot of reasons. They're more efficient, they're more transparent, a lot of reasons that we want to be there. So the question is naturally occurs, well, hey, I've got all these mutual funds now. Well, I want to move over to exchange-traded funds. Is there anything that you have to watch out for? Are there any traps? Could you get yourself in trouble by accident? Well, that's a great question. So Banks and I, we were actually swimming in the pool earlier this week when we were talking about this one. I don't know about you and your dogs, but man, our dogs, I think they think the pool is their pool, not our pool. And you let them outside and bang, they're in the pool in the summertime about as fast as the kids are. So anyway, we're swimming in the pool. I said, Banks, we like these ETFs, but people are asking, are there any problems going from a mutual fund to an ETF? And he looked at me and after looking me in the face a couple of times, he said, well, Dad, actually, there are a couple traps you have to watch out for. So let me tell you what she told me. And you know what? I checked out her answers. It turns out she knows what she's talking about here. Basically, it works like this. If you have your money in an IRA or a 401k or a 403b or a Roth IRA or a SEP IRA, any one of these tax retirement types of accounts, you have nothing to worry about. You can go from a mutual fund, you can sell the mutual funds, buy ETFs, not a problem, never an issue. There might be a few minor expenses of doing so, transaction costs, but just minor stuff, nothing to be concerned about. That's not going to ever be a problem. But there are some traps. There's one particular tax trap you have to watch out for when you are doing this in an after-tax account, like say it's a personal account or a joint account or a trust account. Let's say you have a brokerage account and you hold 5 different mutual funds or 20 or 30 or whatever the number is. And you say to yourself, yeah, I get it. I don't want to own mutual funds anymore. I want to own exchange traded funds. So let's sell the mutual funds and let's replace them with exchange traded funds. You have to watch out for the tax consequences when you sell something in a taxable account like a personal account or a trust account, etc. So here you go, you've got your own, this is money you've paid tax on, it's sitting in your personal name. If you sell something at a gain, you might have a capital gain to pay. I mean, I had a couple come in the office last week and they had an account like that. They had $650,000 in their after-tax account. Do you know what their cost basis was? It was like $400,000. They had $250,000 of gain. And they wanted to sell those positions and replace them with exchange traded funds. I said, whoa, don't go so fast. Because if you sell those mutual funds, you're going to pay tax on $250,000 of gains. Now, let's be honest, nobody ever went broke paying the capital gains tax, right? Because that means you made money, and that's okay. But still, on 250 grand at 15%, that's like what? Close to 40 grand of tax? 37.5, something like that? I mean, you don't want to have April 15th come around and out of the blue suddenly you owe an extra, $35,000, $40,000 in tax just because you sold something you didn't expect it. So I talked to them about that, and they said, well, let's do this then. Let's sell the positions that have lower tax, lower gains. We'll start there, and we'll do it in steps. And that's what worked for them. But the big trap here is it's a tax trap. Watch out for when you make sales in after-tax accounts. So that's a great answer by Banks. And while we're running out of time, so I have to wrap up. Hope you enjoyed our show this week. Had a great show. And have a great weekend, everybody. Look forward to seeing you again next week.